Today I'm going to talk to you about cash flow management, another flip lesson for Business Studies 3 students. What I will talk to you about. First of all, what is cash flow management, the cash flow cycle, and now we look at the cash flow statements, the purpose and the format. When we talk about cash flow in the future, we need to talk about cash budgeting, the difference between cash flow and profit, and examples of overextension of finances and the strategies to fix them. Okay, first up, cash flow. It's the movement of cash in and out of a business. Matching cash coming in and out of the business is essential. Cash flow is the lifeblood of any business. Cash to a business is like blood to a body. Existence without cash flow can cause a business to go bankrupt, even though it may have many assets and have made some profits. Shortfalls. They can lead to cash flow problems and must be dealt with in a short term, otherwise the business can risk bankruptcy. Cash flows need to be monitored on a regular basis. Monthly basis would be preferable. In this instance, cash flow statements should be produced. Normally they're only produced every year, but they can be produced on a monthly basis to detail where the cash has been generated and spent. Now that information is really important. And cash budget in relation to forecasting. This is where we're trying to forecast in the future what our level of cash will be. So businesses need to prepare a cash budget to forecast any expected shortfalls or expected cash surpluses. Now let's have a look at what constitutes cash flows. Here on the diagram you can see there's a number. Cash sales, when we sell our products, when we have amounts sold on account and when they are paid back to us. Other income in terms of interest, non-operating income, for example, rent revenue. Cash outflows, we've got payments for stock, which is our biggest expense, along with wages normally, other expenses, insurance, rent, etc. And also here payments for non-operating expenses. These payments can include things like buying assets, paying back liabilities, and quite often the owners have to draw out money to live themselves, and that's called drawings. An essential part of understanding cash flow is to examine the cash flow cycle. You start with cash. We're talking about a trading business. It then buys inventories, hopefully the right inventories that people want to buy. A markup is put up on those inventories. For example, if I'm in a clothing shop, I might buy some jeans for $50, and then I put a markup on it of say 100%, which means another $50. Therefore, the sale price would be $100. Now, hopefully, I'm going to make a quick sale, so it goes to the sale stage. If it is a cash sale, then it goes straight back up to here. But in some instances, we allow our customers to buy from us on account, which means then it goes to the receivable stage. A normal business might give account for 30 days, and hopefully within 30 days that cash is paid back to us to complete the cash flow cycle. So obviously the quicker that we can make this go around, the better it is for the business. As soon as we got the cash back, we can buy more inventories and make more profit via the markup here, or pay our employees or pay back our loans or whatever we need. But the important thing is the quicker we can get this cash cycle completing, the more ability the firm has to meet its obligations.